Hello everyone. Welcome to Capital Street FX. In the last video, we have gone through the basic concepts of commodities. Like other goods or assets, commodities can be traded for many purposes. To investors in particularly, they buy and sell commodities to take profit from the price movements. Today, as we promised, we will tell you about ways to invest in commodities. There are many routes to take part in the commodity market. Either directly by buying commodities physically, or indirectly, by buying shares of commodity companies, or investing through a fund or an investment trust. The simplest and most traditional way to invest in commodities is to buy and hold the actual item. This way has generally been done with precious metals, like gold, silver or platinum, which are small in size and not perishable, or bulky, like agricultural products. However, if you would like to expand your portfolio, or you see the opportunity when investing in a certain asset, those perishable and bulky factors may need to be taken into consideration. Additional costs of shipping, insurance, and storage will dent much of your profit. Another way to investing in commodities is buying commodity-related stocks. For example, if you want to assess natural resources, such as oil and gas, you could buy stock in companies that drill, transport, or sell oil such as BP or Royal Dutch Shell. Stocks are easy to buy, hold, sell and track, but be careful. Your investment will not only be subject to changes in the price of the commodity, but also correlates with movements in the stock market. Therefore, a more popular way to invest in commodities is through futures market. Futures contracts allow you to buy or sell a commodity at a specific quantity at a set price in the future. There are two kinds of players in the futures market: hedgers and speculators. Hedgers can be farmers, manufacturers, importers and exporters, whoever wants to secure the future price of a commodity against the price risks. The holders of the long position in futures contracts are someone who would like to buy the commodity in the future, so they always try to secure the price at the lowest. On the contrary, the short holders of the contract are individuals who want to sell the commodity, so they will want to secure the price at the highest. In contrast with hedgers, who want to minimize their risk associated with price volatility, speculators want to increase their risk and therefore maximize their profits. Speculators close out the positions before the contract is due, hoping to profit from changes in the price of the contract rather than owning the product being traded. There is a less risky way to approach the futures markets without trading straight futures contracts, that is trading futures options. Before you can trade futures options, it is important to understand the basics. What are futures options? An option is the right, not the obligation, to buy or sell a futures contract at a designated strike price for a particular time. Buying options allow one to take a long or short position and speculate on if the price of a futures contract will go higher or lower. There are two main types of options: calls and puts. The purchase of a call option is a long position, a bet that the underlying futures price will move higher. The purchase of a put option is a short position, a bet that the underlying futures price will move lower. Next time we will continue with the topic of how to invest in commodities by guiding you through how to trade commodity futures and options. Before we meet you in the next video, you can go to Capital Street FX and open a free demo account to have first-hand trading experience with commodities and many other instruments. Thank you for watching.